Hello, and welcome to our 2026 Market Forecast presentation. I'm Marcia Zappa, Director of Marketing and Business Development at Affiance Financial. Tonight's presenter is Marc Usem, Partner, Financial Planner, and Chief Investment Officer. Marc brings more than 30 years of investment experience, including more than a decade of helping to shape the investment philosophy at Affiance Financial. Marc, I remember during last year's presentation saying that it was nearly a decade, and now we've reached that 10-year mark.
Keep it going.
That's right. Congratulations. And thank you for all that you do for the Affiance team and for the Affiance clients, including putting together this presentation every year.
Thank you.
Before we get started, I do have a few housekeeping items to share. Tonight's presentation is recorded and will be shared tomorrow via email. We will not be answering questions live during the presentation, but the Q&A function is activated within the webinar. So if you have any questions during the presentation, please type them into the Q&A. Our team is standing by to collect those questions, and we will reach out tomorrow during business hours with answers. And finally, an important disclosure. Please remember, there can be no assurance that the content made reference to directly or indirectly in this webinar will be profitable or suitable for your individual situation or prove successful. Dividends and earnings fluctuate and are not guaranteed due to various factors, including changing conditions and/or applicable laws. The content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that any discussion or information contained in the webinar serves as the receipt of or a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon request. And with that, let's get started.
I'd like to introduce our Affiance investment team. Myself, Marc Usem, Chief Investment Officer, Tanner Steele, our investments analyst and data manager, and Zachary Clues, our investment analyst and trader. We all work closely together every day to monitor our investments. We also have an investment committee, which the three of us sit on, as well as Andy Fishman, our founding partner, Eric Unger, our president and partner, and Brendan Halloran, an advisor and partner. The investment committee is a critical piece of our process. We meet monthly to review investments and our strategies, make sure things are in line. So our agenda for tonight is to first take a look back at 2025. We'll look ahead to 2026. We'll focus on several areas. We'll look at fundamental factors that influence the market, artificial intelligence, some of the risks, and finally, our recommendations.
Well, let's dive in. As we do every year, I'd like to start by finding out how your forecasts fared last year.
Marcia, this is always the most stressful part, is looking at what we said last year and how did we do. But let's walk through it. Our first item is S&P 500 earnings. We estimated $271 a share. We think it's about $270, so maybe we were just $1 or so light, so pretty close. We estimated the S&P 500 PE ratio at 25. We're just a hair above that at 25.35 as of the end of the year, so pretty close there too. The S&P 500 level, which is just a function of those two other numbers multiplied by each other, 67.75 was our estimate, ended the year at 68.45. Nice. So pretty close there too, just slightly underestimated it. Fed policy, we said would be dovish. Certainly was dovish. We had 3 interest rate cuts last year in September, October, and December. Fiscal policy we thought would be mixed, and indeed was mixed. Several things happened through the year, including the One Big Beautiful Bill Act, the tax changes that took place, tariffs, and deregulation, all sort of were part of what we expected to have happen, and they did in different ways, but nonetheless was a mixed picture. So overall, pretty close on what we expected last year.
Okay.
Let's take a look back at market performance in 2025. So 2025 was a terrific year for markets. All markets hit records during the year. led by international. Emerging markets on the top at 34% last year. International, 31.6%. S&P 500, our domestic market, up almost 18%, and bonds up 7%. So across the board, really good performance last year. Now, people may have forgotten that in April, there was a significant downturn, almost 20%, before jumping right after that. And you can see that bonds actually held up really well through that period, meaning it kind of provided that diversification that they're supposed to do.
Marc, what would have happened if an investor had gotten out and stayed out for that April 9th rebound?
Right, there was a one-day return of almost 10%. And if you had missed that day, if you had tried to time the market after that downturn, you would have only been up 7 or 8% instead of 18.
That last year was a great example of why it's important to stick with your financial plan.
Exactly. Let's focus for a second on that international piece. So international markets were up 15% more than US markets last year. That's a tremendous difference, right? And the biggest difference in an up market since 2017. The biggest difference in markets over time is actually since 2009, meaning almost 14% difference then, almost 15% last year. So I think the key is diversification. We want to keep global diversification because we don't know when that's going to take place.
This trend has been so pronounced that I know some investors started questioning why we were continuing to invest in global markets.
It's been a lot of years of U.S. outperformance for sure, but this significant outperformance in last year is again a great example of why we have to stay diversified.
That's right.
Let's look at styles and sectors last year. Last year, we saw growth continue to outperform value, and large caps continue to outperform small and mid. In terms of sectors, we saw technology and communication services lead again. And I think it's just interesting to put into perspective where that Magnificent Seven stocks that they talk about all the time are within the sectors. So, for example, technology holds Apple, NVIDIA, and Microsoft. Communication services holds Alphabet and Meta, the top two sectors. And consumer discretionary actually contains Amazon and Tesla. And you can see that was not one of the top sectors last year, but nonetheless, those stocks are part of that. They didn't do as well as the others.
You know, this looks really similar, really familiar as well. How long has this trend been going on?
We've seen this trend, specifically the growth in value difference going on since the great financial crisis in 2009. It's been interesting that it's been going on so long, but we don't see it changing anytime soon. This graph shows the concentration of those top 10 companies in the S&P 500 and how they've grown over time to now almost 40% of the S&P 500, which is a lot. It's a record. Also, you can see the total market cap of those companies has climbed rapidly to over 24 trillion for just the top 10 companies. Hard to fathom those numbers.
It is. Marc, is it a concern how steep this curve is growing?
You know, I think it's a good point. I think there is some concern that the market's become very concentrated in the index with those top 10 companies. Certainly it's at a record, but I don't expect that to change anytime soon. One of the reasons is the Mag 7 monopoly. The industry market share that these companies control is really unprecedented. Alphabet in search still owns over 90% of the search market.
Wow.
NVIDIA, almost 85% of the data center market. Meta, 73% of the social media market. I mean, these numbers are just tremendous. Microsoft, after all these years, still at 73% of the desktop. We can see Tesla at 50% of EV sales, Apple 50% of smartphone sales in the US, and Amazon at 40% of online sales. Amazon Cloud, even at 30%, is still dominant in the cloud computing area. So this monopoly power is one of the reasons that these companies have become such a large part of the index.
And it's unlikely that we'll see this change in any significant way because they've gotten so big that they're just buying their competition.
That's a real factor. As somebody gets closer, if a technology looks like it might be, threatening these companies, they have the resources to buy them before they get in the way. So probably doesn't change anytime soon. Let's take a look at the Magnificent 7 versus the fabulous 493 in 2025. As we said, the S&P up about 18%, Mag 7 on a cap-weighted basis up 23%, and the rest of the S&P, the 493, up about 13%. So the Mag 7 still had a significant influence on the S&P 500 last year, accounted for about 42% of the total return versus 50% in the prior several years.
And that's a good thing, right? That it's coming down.
It is a good thing. We're seeing that market breadth increase. More stocks are up more, so that's a good thing. If we look for a second at earnings and multiple factors, we're going to explore the different things that influence earnings and PE multiples. Let's go around the horn here. Earnings and growth rates are one of the key issues. Profit margins, interest rates, monetary policy, fiscal policy, and investor sentiment. And the magnitude and influence of these factors can vary significantly over time. First, let's look at S&P 500 operating earnings. This is really an important piece of trying to figure out what markets might do. Last year, we were up about 16%, from $233 to about $270 this year. 2025. Looking ahead to 2026, we're expecting $310 per share, which is about a 14% increase, so pretty close to the prior year. If we do some simple math and just say, look, assume the PE ratio doesn't change, stays at about 25, we get 310 times 25 gives us 7,750 for the S&P 500 level a year from now.
And these are the numbers that we'll come check in on again at next year's presentation. So how confident are you in these estimates?
Well, we always like to say we're cautiously optimistic that we're correct. In general, analysts tend to take down estimates over the year, during the year, so that what happens is the early part of the year, we're very optimistic, and as the year goes on, it tends to wane a little bit. Last year was the opposite, actually. Last year, estimates continued to rise through the year, which was kind of unique.
Yeah.
This year, we'll see what happens, but I would say 310 is still where we'll stick for now.
Okay, fair enough.
Profit margins are another important piece of the puzzle. Higher profit margins tend to support higher valuations. And we can see the trend, at least since about 2010 or so, has been higher. Now, certainly this is a very squiggly line, and you can see recessions have influences on operating margins, as well as COVID kind of made the numbers look very strange as markets closed and reopened. But we're at the highest sort of normalized margins we've been at in history.
Do you see this kind of continued higher growth being sustainable?
I think it can continue to trend a bit higher as the largest companies become a bigger part of the S&P, like we showed before. Those companies have profit margins that are almost twice the rest of the S&P 500. So the mix actually leads to this, maybe it doesn't go a lot higher, but I could see it inching higher.
Okay.
Let's look at interest rates next. So interest rates definitely influence markets. And in 2022, for example, when rates rose rapidly, we saw one of the worst years ever for stocks and bonds. Rates have been stable sort of since that time through the last several years, and that's generally a good thing. We're at about a 4% 10-year treasury rate. It's sort of been in this range, and we don't expect that to change anytime soon.
Mark, is it the interest rate itself, or is it the movement of the interest rate that really affects the economy and the markets?
It's kind of both. So when rates are moving rapidly up and down, like 2022, it can definitely influence markets during those periods. But the level is important too, meaning higher rates generally are not as good than lower rates because those cash flows are getting discounted at a higher discount rate. So the real key, I think, is that we have moderate rates, which is kind of where we're at, and that they're stable. Let's look at monetary policy in the Fed, clearly an important input to what's going on in markets. And we think it stays dovish. That's accommodative monetary policy. Further rate cuts are likely in 2026, although probably not till the later part of the year. And there's going to be a new Fed chair appointed in May.
So there's been some current rhetoric that Jay Powell may not make it until May. How do you think the markets might react to that sort of change?
Well, I think that would not be good, but I don't think it's very likely. I expect Fed Chairman Powell to make it through his term in May. I know the Department of Justice sort of opened an investigation into the remodeling of the Fed, actually, which is kind of interesting. But I don't think he'll go anywhere before the end of his term.
Okay.
Let's look at the Fed funds rate and CPI, which is a measure of inflation. So the blue line is inflation, and you can see it spiked after COVID. The green line is the Fed funds rate. The Fed was kind of behind the ball as inflation rose rapidly, and then they started to increase interest rates as inflation fell. And those things kind of work hand in hand. And we're now in a normalized kind of situation where interest rates are higher than inflation. That's usually the case over history, and that's probably a good thing because it actually allows savers to have a return that's higher than inflation for savers. And right now, the inflation rate's about 2.7%. It's been stable for the past couple of months. And that's a good thing. Allows the Fed to probably lower interest rates a little bit during this year.
The 2.7% is still a bit above the 2% goal that the Fed has. What do you see happening with inflation throughout 2026?
Well, it's a good question because it's hard to estimate inflation, but I expect it doesn't change dramatically from where it is today. It probably is in this 2.5, 2.7 range based on what we see in the economy right now. Now, there's things that could affect that potentially, changes in tariffs or other things that we can't necessarily know today, but probably stays in this range, which again, stabilization, and which you can see has been pretty stable for the last several months, is a good thing. Mm-hmm. The second piece of the Fed's dual mandate, which is low inflation and maximum employment. We'll look at the employment piece here. The unemployment rate at 4.4%. Now we can see it's trended a little bit higher since COVID, which is expected because it was such a big shift there. Mm-hmm. But it's moderated and actually down a little bit from November. I think employment's a critical piece for the Fed to continue to watch, and a lot of questions remain about exactly what the natural rate of unemployment is today.
There have been a lot of headlines about AI taking jobs. Do you think we'll see evidence of that in the data as we move through the year?
You know, AI is definitely going to have some impact. Exactly how much and how far it goes, I don't know. Does that potentially influence the natural rate of unemployment, or what sort of where things might land? It could make it that the unemployment rate lands at a little bit higher level. But it's still, I think, too early to tell exactly what that means. Focusing on GDP, gross domestic product, over the last several years, last year was really a tremendous year. We can see the last three quarters in particular, up 3.8, 4.3, that just got revised to 4.4, and an estimate of 5.3% for the fourth quarter of last year. Really strong growth for a $20+ trillion economy. But
Mark, what happened in quarter one of last year?
Quarter one's a good example of a really strange number because it shows down, right, 0.6%. But what happened in the first quarter is that people were concerned about tariffs because that was well telegraphed, and they brought inventory in, in anticipation of what might happen. And so because GDP is a simple function of consumer spending, investments, government spending, and net exports, it's that net exports piece that actually influenced it so much. So if we hadn't had that extreme situation where they brought in all this inventory, probably would have been closer to 4%.
Oh, wow.
Looking at fiscal policy in Washington, D.C., we expect that to stay mixed. We know that there's going to be higher government spending. Lower taxes have already been kind of baked in. Deregulation's taking place. Those things overall pretty positive. But at the same time, we have smaller government. They're reducing the size of government. That's actually kind of a negative in terms of government spending. There are higher tariffs in place today, which are a tax. And then lower immigration, which from an economic perspective actually is a negative from a GDP growth rate perspective. Fewer people buying stuff. So still a mixed picture for fiscal policy.
Yeah, so those mixed signals are all really interesting. But how do you think they'll affect the stock market?
All I can say is it creates a lot of volatility more than anything. Any one of them by themselves probably doesn't have a huge impact on the stock market, but overall, as different pieces of information come out about them, it does tend to create some volatility. Let's look at investor sentiment. To me, this is one of the most interesting parts of the psychology of investing. We call it climbing a wall of worry. Kind of that's where we're at today. It's the market's ability to keep going up despite negative economic news. So right now, the biggest concern is the market valuation and the AI bubble. That's been in the headlines a lot, and it's rattled investor sentiment. But it's really a contrarian indicator. As markets tend to climb a wall of worry or advance even when investors are nervous, that's a good thing. It's good to have people be nervous about where things are and have some concerns. When the wall crumbles is when consensus optimum is at its peak. When everybody thinks it's great, everybody's ready to jump in, that's probably a time to be more cautious. We're going to switch gears here after looking at earnings and the PE multiple, and we're going to focus on AI for a minute here, which is one of the primary drivers of growth and the most consequential force shaping the global economy today. First, we'll look at the AI adoption rate versus prior technology. This is incredible to me. The line is almost vertical, where other technologies took much longer, even though they were fast, they took much longer to be adopted. I think interesting to note, OpenAI, which is one of the leaders in AI, has more than 1 billion average weekly users, up from 200 million just 2 years ago.
Wow.
1 billion weekly users. Crazy.
You know, the thing that really stands out to me when looking at this is that of all those different technologies in the graph, AI was offered for free.
It's a good distinction. It's a good distinction because certainly you had to pay for your cell phones and you had to pay for internet, electricity. So being free is definitely a factor. Although the interesting thing is these companies are actually generating significant revenue.
That's right.
If we look at OpenAI, for example, the expectation is that they actually grew over 13 billion in revenue last year. That's up over 280% from the prior year. And we just got some anecdotal information that Anthropic probably generated about 5 billion last year.
Wow.
So they are turning this into revenue, both from the corporate side and the consumer side. I wanted to also just focus on OpenAI's historical valuation here because this is astounding. After just a handful of years, this company has grown to what's 500 billion in valuation based on the prior investments in 2025. 2026, the expectation is that it could be worth over $830 billion. This would put it into the top tier of S&P 500 companies. It's the size of like a JP Morgan or an Eli Lilly in just a handful of years.
Mark, do you think this is the fastest growing private company ever?
It definitely is one of the fastest growing private companies ever at this kind of valuation in just a handful of years. We've never seen anything grow like this and to this scale and magnitude so quickly.
Amazing.
Let's take a look at the AI versus .com era earnings and valuation. I think this is a very important component to look at today.
Mark, are the scales on those two graphs the same?
Scales are actually the same. Each is a handful of years, 5 years across the x-axis. Both go from 0 to 500 on the y-axis, so same scales. On the left side is the .com bubble. And you can see how prices diverged so significantly from earnings, almost 4 to 5 times the growth rate of earnings. So pretty good example of a bubble. On the right side, we see the current era, the AI era, where earnings are supporting stock prices. I think really critical difference to look at here. That earnings growth is supporting stock price growth today. If we dig into last year specifically, we can see fundamentals, earnings growth, that 13.6% of the total return was the biggest part, with dividends at 1.5 and the change in PE, a slight change in PE, up a little bit to 2.4. So fundamentals, again, not sentiment, drove stock performance last year.
Yeah, and this is really key to understanding the slide we were on before, that we're not in a bubble.
Not in a bubble based on history, definitely not. But caution is warranted. So when stock prices are at record highs and the market is concentrated, I think the right question to ask is,
what could go wrong?
So let's look at some of the potential things to consider. This is intra-year declines versus calendar year returns going back to 1980. It's a busy slide, but I think the point is that even in strong years, markets can be volatile. And we can see that even last year, markets were down almost 20% in a great year. So expect volatility.
Yeah, it's hard to even remember that markets were down that far last April.
They can change rapidly, right? Even 2020 with COVID, that 34% drop, erased within the year. So sticking with the plan is critical. Midterm elections are going on this year. And this is an interesting chart that shows all other years versus midterm years. And you can see in those midterm years, markets tend to be sort of volatile and flat until those midterm elections take place. And that certainty is what the market likes. Certainty. They want to know what's going to happen. After those elections, the markets tend to do better.
Well, not only that, but isn't it also true that the incumbent party tends to lose midterm elections? So that could have a big effect on fiscal policy as well.
That's an important factor in that the incumbents do tend to lose seats in midterm elections. And because Congress is so close in terms of seats, that could switch the power balance a little bit. Again, markets like some certainty. And when you have a different party in the White House and in Congress, it kind of gridlocks things. Markets tend to like that. Another potential issue is the AI build-out and energy needs. This is the data center power demand announced from OpenAI partnerships last year, which is almost 30.5 gigawatts of new power required. This is the Oracle, AMD, Broadcom, and NVIDIA deals. So what is 30.5 gigawatts? It's enough power to actually power almost 25 million homes continuously.
Wow.
Our power grid's not even designed to handle that yet. And so energy is a real big potential thing that could slow down the adoption of AI.
So I have started to see some headlines about quantum computing. Is that something that could potentially address this roadblock?
It's very interesting. Quantum computing is growing rapidly, but it's not yet ready for prime time. I think we're still 5 to maybe 10 years away from commercialization of that technology, but the increase in speed that it allows could actually help with energy issues, meaning you could do more with less.
All right.
Of course, there's ongoing geopolitical risks. One question is, has the U.S. action in Venezuela emboldened China in their desires for Taiwan? Of course, there's other things going on around the world as well. But Taiwan is a very special situation because of Taiwan's semiconductor. They are one of the biggest chip manufacturers in the world, and the top 10 technology companies really rely on Taiwan Semi to supply them. So even though there's geopolitical risks in different parts of the world, Taiwan Semi is kind of a special situation.
Now, the latest headlines have all been about Greenland. What impact do you think that could have on the economy or the markets?
Well, Greenland's a great example of sort of some of the risks that could be out there because the issue of tariffs was put on the table for people, European countries in particular, that wouldn't support us. We were going to have additional tariffs. That got turned around quickly. There's a deal in the works. But those kinds of things can definitely create volatility in the market. So again, something to watch, not something we can control.
Right.
Valuation risk is another issue. So markets aren't cheap, even at 25 times earnings. Now, we've said that we think that there's support for the current PE ratio and earnings, but that doesn't mean it's cheap.
So even though you make the case that these are supported, it's still a risk.
It's still a risk. You know, we're not at the average of 20 or even below the average. So you just have to put that in the mix of there's not a lot of room for error. Another important factor is the independence of the Fed. Political control of the Fed leads to higher inflation as lower rates are prioritized to boost economic growth and job creation. Certainly in the current situation, we've seen political pressure applied to the Fed in a way that we've never really seen before. So this is a unique situation.
What are the long-term effects of the loss of independence for the Fed in addition to just higher inflation?
Well, we can see some other potential issues, such as a reduction in foreign direct investment if foreign investors are less confident in our Fed, as well as potential risk to the US dollar if that were to be the case. So there are other issues that we'd have to worry about. Independence of the Fed is really important. So let's look at our outlook for 2026. First, temper expectations for outsized returns in the early part of the year. Like we showed, it's a midterm election year, so expect volatility in the early part with probably better returns in the later part of the year. Earnings and P multiple factors support continued stock market advances. We expect some volatility and drawdowns during the year. It's a normal part of investing. Monetary policy is probably going to be stable with a bias towards lower rates. And bonds should remain supportive and earn their coupon in a stable rate environment. Bias for rates probably a little bit lower, maybe a little bit of tailwind there.
So even though earnings and PE multiple factors are supportive and monetary policy is supportive and bonds are supportive, you still think that we should be thinking about inter-year volatility and drawdowns.
Definitely. I mean, we saw the chart, but the headline risk is something that we don't even know what it's going to be. We've seen some things on the table, whether it's tariffs, geopolitical risks that we talked about, but it's always the things that we can't expect that's going to cause some kind of volatility.
Makes sense.
So our recommendations: don't try to time the market. We saw the risk last year. We've seen it over and over again. Missing that almost 10% day would have hurt your total returns. Stick with your financial plan. Stress test as needed. In our software, we can do specific things to show different stress tests, like a Great Recession loss, higher inflation, Social Security cuts. What if there are lower returns than we expect? If somebody were to die earlier or live longer, how does that affect your plan? If you needed long-term care when you're in your older age, what would that look like? Or even cuts to a pension. We can model all these things if somebody has concerns.
That's right. And these are built right into our financial planning software. So talk to your financial planner if you would like to see how any of these scenarios affect your financial plan.
So we're going to maintain a disciplined investment approach. Like we like to say, we are not bullish, we are not bearish, we are process. And we've made changes to portfolios based on market conditions. Doesn't mean we don't do anything. We're watching. And we know we can't control the markets, but we can control our actions. And you can rely on us for providing a disciplined approach to investment strategy, investment process, and holistic financial planning.
That's right. Thank you so much, Marc, for this presentation as always. And thank you, Affiance clients, for attending tonight.
Thank you, Marcia. Great moderating. And thank you to everyone for joining us.